Hello, Mr. Faber.
Yes, good
So
afternoon.
great to have you with us on Bloomberg TV Bulgaria. Marc Faber is one of our favorite investors of all time, very well known in Bulgarian investment circles. Your book, Tomorrow's Gold, Mr. Faber, has had a huge impact on me and Vlado, so thanks for joining us. Let's talk about China first. Very topical investment issue right now, there is no doubt about that. Has the stock market in China found the bottom or the fiasco lies ahead, Mr. Faber?
Well, nobody knows if we've seen the lows, but very clearly the market is basically back to where it started the rally in June 2014. After June 2014, we had a very powerful rally and many stocks went up 100%, some 300% between June 2014 and July 2015. And after July 2015, everything crashed. So we made a round trip. Stocks are not terribly expensive, but obviously the market is beginning to adjust, and by the way, other markets as well, to the reality that the economy is very weak. I've been talking about weakness in China and the weakening economy for 3 years. And it was very obvious in 2014 and especially in 2015 as commodity prices collapsed, as the Baltic Dry Index collapsed, as exports started to sputter or decline, as imports went down, that not all was well in the economy. And now, finally, and I say finally, the investment community and also the mainstream media wakes up to the fact that the Chinese economy might be a problem. Because don't forget, after year 2000, the incremental demand from China for raw materials, in other words, commodities, industrial commodities, drove up their prices. As a result of that, countries that essentially produce industrial commodities, the Middle East, oil, Russia, oil and other metals, and Africa, Latin America, Central Asia, Australasia, all these countries became affluent. Their economies were growing rapidly. As a result of that, capital investments in these countries went up, all driven by the Chinese demand. And so when the demand from China slowed down starting in 2014 and commodity prices went down, all these countries got into relative trouble. And they had less money to buy goods and so forth. So it affected the exports from the industrialized nations and, of course, also from China. And so you had a vicious circle on the downside. But this was all obvious already a long time ago. The reason I was bullish about Chinese stocks in 2014 is that in Asia we have a pool of money that flows around. It's invested in Japan, it's invested in South Korea, Taiwan, India, and so forth. And by the summer of 2014, the only market that had performed horribly was China. So I said to myself at that time, the money will flow out of the Philippines and Indonesia that had gone up 3-4 times since the 2009 lows and flow into China. But obviously, the economy was slowing down. That people had to realize. It was just the money flows that drove stocks higher until the summer of 2015. And then we had the big crash.
Mr. Faber, for years China has hitched the yuan's value to the US dollar, but its central bank signaled in December that it would break the peg and instead manage the Chinese currency against a basket of 13 currencies. What is your opinion?
Well, basically, most currencies have been weak against the US dollar since 2011. and in particular the commodity-related currencies like the Australian dollar, the Canadian dollar, and of course in the case of Russia, there was weakness for other reasons as well. But in general, the US dollar was very strong. And until 2015, early 2015, the Chinese RMB was actually appreciating against the US dollar. When, say, another major trading nation in Asia, Japan, had a policy to weaken the yen considerably against the US dollar. And so when the Chinese leadership realized that their economy is much weaker than their statistical offices are contending, they thought, okay, let's take some of the pain through a currency depreciation, which was also added or caused by huge capital outflows. There's a lot of capital flowing out of China. Now, is it all capital that is fleeing China from rich people who are afraid about the Chinese economy and so forth, or they are afraid about a significant devaluation, or is it legitimate capital that flows out for investment purposes and also in order to pay the interest on loans that have been made in US dollars? That is difficult to break down. But basically, the increased capital flight from China had the impact to also lower the value of the yuan. And I think it's likely that it will go lower. But against a scenario where it's been a very strong currency until recently, even against the US dollar.
As you mentioned, Mr. Faber, the sharp slump in oil prices has affected the global economy. The country producers of oil are experiencing blatant fiscal shocks, dollar shortages, and depletion of foreign reserves. How severe could be the repercussions of this price decrease?
Well, it was clear that if you look at global liquidity and you define global liquidity as essentially central bank holdings of free reserves, that this global liquidity was still rising, but it was rising at a diminishing rate of growth since 2011. And now it's turned negative in the last 6 months, which means that global liquidity is contracting despite the efforts, in particular of the Bank of Japan and the ECB, to flood the market with liquidity. It's contracting. And in my opinion, the contraction in international liquidity would need to have an injection of liquidity to, say, offset it. And I'm not suggesting that this would be a desirable measure, but just to offset it would have to have an injection of liquidity in the order of, say, $4 to $5 trillion.
Mr. Faber, the Saudi Riyal has been under considerable pressure as the price of oil has fallen. What is your comment on the matter?
You mean Saudi Arabia?
Yep, Saudi Arabia.
It is to be hoped that with the collapse in oil prices, the arrogance of the Saudis will also be deflated somewhat.
Mr. Faber, negative nominal yields and zero interest rate policies. Is this the new era in the field of finance and investments, and how do we survive it?
Well, that is a very interesting question, because if you look at the history of interest rates and the books about the history of interest rates, say Sidney Homer, notably, that goes back to interest rates at the time of Babylon. And in this whole period of history of, say, 4,000 years ago up to today, in other words, 6,000 years of recorded human history, interest rates have never been this low, never.
Fair
this
enough.
is now really a new experiment by a bunch of academics that populate the glass buildings of central banks. And this experiment, in my view, will go very bad and end very badly. In my view, there is no way that it can end well.
However, the Federal Reserve seems pretty determined to raise interest rates no matter what. Are there any pitfalls we should be aware of regarding Yellen's future actions?
Well, determined to raise interest rates
Seemingly.
by the Fed, that may be your view. This is certainly not my view.
This is what they say.
I believe that the Fed has made already numerous mistakes over the last 20 years. And these mistakes compound each other. The last two mistakes were they should have increased the Fed fund rate in 2011, 2012 by, say, up to, say, 2% per annum. But they didn't do that, and the zero interest rates have produced, again, bubbles, especially in the lower quality credit markets and in emerging markets. So now, on top of the problems in Western Europe and the US, we have also a big problem in emerging economies. And in my view, the Fed, at the next Fed meeting, will realize the mistake they made. This is precisely the time they shouldn't have increased rates, but they did it. So they will go neutral. They will say, well, we always said we are data dependent, and the data has worsened, and we have international tensions in the capital markets, especially the credit markets, and we have weakening economic statistics, and the fall in oil price. They'll blame everything, and then they want to increase rates further.
In this context, if you think stocks will crash over 40%, for example, and the world is on the verge of a new liquidity and debt crisis, what is your opinion on investing in gold?
Well, first of all, I have to clarify the statement about crashing 40%. I said very clearly that, in my view, the market in the US could easily decline from the May 2015 high, which was 2,134, by 20 to 40%. This was my statement. And the average stock, may I remind you, in the US is down already 26% from its 12 months high. And on Friday, 10 days ago, we had over 1,000 new lows on the New York Stock Exchange. This is a very rare occurrence. And when this happens, it shows you that beneath the surface, the market has been weak for a long time, but the indices were held up by the always bullish media, and of course by a few stocks, like they call them the FANG stocks, Facebook, Amazon, Netflix, and Google, and maybe another 20 stocks. They kept the index up, but the typical stock was down. So now we're already down basically by the average stock 26% from the May 2015 high. And this implies that the market could, in my view, decline another, say, 20% from here. I don't think that this is a crash. I think it's a very gentle decline.
Something about the gold, and what is your prediction about the price spread between gold and silver? And of course, we're speaking about some tendency over the next 2, 3, 5 years.
I think that responsible investors have to understand, you and I and nobody of your viewers know exactly how the world will look like in 5 years' time. So in absence of knowing, what do? You diversify, and you take a view that certain things will work out and certain things will not work out well. What we all know is that the financial system is disproportionately large compared to the real economy that generates the cash flow in the world. And this financial sector, in my view, will have to be deflated one way or the other. In other words, the debt level has to come down, and probably also equity market valuations. And we've had significant weakness in financial stocks over the last 12 months already. Many fund management companies are down 40%. Lately, banks around the world have collapsed. Some banks in Europe are lower today than at the lows in 2009. So there are strains in the financial sector. And in this environment, you want to have some money outside financial assets. In other words, you want to own some real estate. Probably real estate in Bulgaria is quite attractive. And you want to own some physical gold, which you shouldn't store in paper form in the US or in the US, but which you should store outside the US, probably based in Asia.
Mr. Faber, some of your esteemed hints are required now. Which are the best sectors to invest in the decades to come, and where?
Well, I mentioned earlier on this weakness in emerging markets, which began in 2011. So if you ask me, and you kind of sarcastically mentioned about my prediction of a 40% decline in stocks, well, it's happened in emerging markets already. Maybe you tell me once, in dollar terms, how has the Bulgarian market performed from its high? I'd be interested in your comment about this. In any event, the emerging markets decline or bear market is in a maturing phase. I believe that whenever the bottom in markets will come, and I don't think it will come anytime soon, there may be strong rebounds, but I don't think the markets will launch a new healthy and sustainable bull market from this level. So I think that when it happens, and this could be 2-3 years from now, emerging markets will outperform the US very meaningfully. So these are, say, the assets I would look at. Number two, right now, and already for the last 3 years, investors have always been very bearish about US Treasury bonds. And I concede that to own a 10 years US Treasury giving you a 2% yield is basically unattractive. But you understand, in the current environment where you mentioned earlier on the possibility of the introduction of negative interest rates equals expropriation. That you should understand very clearly. So the democracies give the power to central banks to expropriate honest people that have savings. It will be a very interesting experiment when they introduce that. But in that environment, I think that 10 years treasuries yielding 2% are not all that bad.
Okay, Mr. Faber, if, for example, I possess some quantity of gold coins or cash or some other kind of assets, the tricky question is, where is the best place to store my assets?
Well, I wouldn't store it in America and in the vassal of America, Britain. And the ECB is probably also beholden to the US. So I think the best place is probably somewhere in Asia, in Hong Kong or Singapore, maybe Dubai, maybe even in Bulgaria. So, you know, anywhere but not in the US. That's what I would do. And by the way, in terms of sectors, as you know, gold has been weak since September 2011. And weak against gold has, of course, been the gold mining sector. So if you talk about the depressed sector, that has significant upside, and I'm mentioning here significant upside, not just 10, 20%, but could easily double and treble in price, I would look at gold miners.
Mr. Faber, what's the appropriate investor's attitude toward risk in this turbulent time? Being defensive and waiting for the storm to pass, or aggressive, trying to pick the bottoms?
Well, it depends on your cash flow, you understand? If you have a very high cash flow, in other words, a very high income, you can say to yourself, I'm going to put some money into the market every month. But if you're not sure that the cash flow will always come, you may end up by owning shares that still decline from here more than I expect. I said, you know, roughly 40% from the high. I think that's a minor decline. I've lived through markets that went down 90%. So we don't know exactly where the lows will be. And in this environment, as I said, I would own some shares, and I would own some treasury bonds, and I would own some physical gold, and I would own some real estate. And in my view, everything will lose money because we had a colossal asset inflation starting the early 80s. In the case of bonds, starting September 81. In the case of stocks, the asset inflation began in August 1982, when the Dow Jones was briefly below 800. So everything has gone up, paintings, vintage cars. And I think this colossal asset inflation will come to an end. And in some cases, like commodities, it's come to an end already. In other cases also, like high-end wines, the prices have also gone down. Some high-end properties have also weakened, and so forth.
Mr. Faber, you always tell people that you're a great optimist. What does it mean for Dr. Doom?
Well, I mean, I believe that there are always opportunities for hardworking people to succeed in life. Even if you were born in 1920 and you had to live through the Depression years and then World War II. I mean, look at my grandfather. He built a hotel in the mountains. He developed the winter sport in Switzerland in 1910. Then he had to live with World War I. Then he had to live with the Great Depression and World War II. And then recovery in the 50s and 60s, but it wasn't that great at the time after the war. So if you execute well your business in your life, you can do well under any scenario. I think that in general, people are concerned about money, and that life is about many other things than money. So you can be optimistic about life without necessarily being optimistic about stocks.
Mr. Faber, in the worst case scenario, given what you said about the global monetary system, the asset price system distortions and so on, where is your favorite retreat in case of global financial cataclysm? I mean, geographically, Asia,
Well,
Argentina, is that a good guess?
As you know, I live in the north of Thailand. And one advantage the north of Thailand, and in fact the whole of Thailand has, is abundance of food. In Thailand, nobody will ever go hungry. There's so much food. So this is an advantage. But obviously, if there is disruptions, say if tomorrow an evil power like the US switches off the internet, you have no internet, can't use the credit card anymore, and so forth and so on. So you have to prepare yourself. I have sufficient reserves in Chiang Mai to last at least 5 years. So, you know, it's nice to have gold, say, in Singapore or in Switzerland or whatever it is, and to have stocks there. But if you cannot ship the gold anymore to where you are, it won't help you a lot. Or it's nice to have money, but But if you have no food where you live, it's not of great help. And you may not be able to escape big cities. So I think to have some property in the countryside, also in Bulgaria, in the countryside, is probably quite safe.
Thank you for these hints.
And maybe the last question, please, or not so question, but something like advice and your opinion of. Please share with us the books and investors you most value personally. It will be very interesting for our audience.
What I value the most?
Books and investors, other investors, your colleagues.
Ah, I see. Well, basically, in my, I think on my website,
except your books, of course.
I have a bibliography, and there I list some books that I think are good. Now, the thing is, like with investors, you know, some books are good about something, and other books are good about something else. But let's say if you want an introduction in, say, how markets move and what the symptoms are of, say, a bull market and a bubble and then the bursting, I think Manias, Crashes and Panics by Kindleberger is a very good book. If you want to have an overview of what really happens in monetary inflationary periods, I think the Economics of Inflation by Bresciano Turoni is very good. If you want to have an idea about it.
Thank you so much, Mr. Faber, for your time. It was a great pleasure, very instructive for us. Wish you all the best from Bulgaria. Hopefully we will see you soon in our TV show. Wish you all the best. Bye.